Have you named your beneficiaries the right way on your retirement and investment accounts? Getting this wrong can result in unnecessary taxes, delayed inheritance, or even render parts of your estate plan ineffective. Hi, my name is Mike Heatwole, founder and CEO of the Dala Group, a wealth management firm focused on helping retirees. In this video, I'll walk you through how to correctly name beneficiaries on your retirement and investment accounts, and how your trust fits into that picture too. So, let's start with what is a beneficiary designation? A beneficiary designation informs your financial institution of who should receive your account upon your passing. It bypasses probate and overrides what's written in your will. That's right, even if your will says one thing, your beneficiary form wins every time. That's why it's so important to review these regularly, especially after significant life events such as marriage, divorce, or death. Now, let's talk about primary versus contingent beneficiaries. You can name primary beneficiaries who receive the account first, and contingent beneficiaries who inherit only if the primary beneficiaries have passed away. For example, you might list your spouse as the primary beneficiary and your children as contingent beneficiaries. You can also list multiple beneficiaries and assign percentages that total 100%. Now, a lot of people ask us, should my trust be the beneficiary of my IRA or 401k? If you have a revocable living trust, you might assume all accounts should list it as the beneficiary. But that's not always the best move, especially when retirement accounts like IRAs or 401ks. And here's why. When a trust inherits a retirement account, the rules for withdrawals can become more restrictive. In some cases, the trust must distribute the entire IRA within 5 years instead of the more common 10-year window, potentially accelerating taxes. So for many people, it makes sense to name individuals, like a spouse or children, as beneficiaries on retirement accounts, and name the trust as beneficiary on taxable investment accounts or other assets such as life insurance policies and savings accounts. So, who should you list as beneficiary? Your spouse, your kids, or your trust? The answer really depends on your goals, family structure, and how your trust is written. If your top priority is simplicity and tax efficiency, listing individuals directly is often the best approach. If your top priority is control and protection, such as for minors, blended families, or special needs beneficiaries, your trust may make more sense. So when does it make sense to use a trust? There are specific situations where naming your trust as the beneficiary makes perfect sense. If your heirs are minors, if a beneficiary has special needs or receives government benefits, if you want to control when and how the money is distributed, if you want to consolidate management under your trustee after your passing, or if estate taxes are expected and the trust is designed to reduce your tax liability. In these cases, the trust provides protection and structure that direct ownership cannot. So, let's look at an example to make this more clear. Imagine a married couple in their early 60s who have $800,000 in IRAs, $400,000 in a joint brokerage account, and a revocable living trust. They ask a common question: should our trust be listed as the beneficiary of our retirement accounts? In many cases, the best approach is to name individual beneficiaries, such as their children, directly on the retirement accounts. This assumes their children can manage their own finances. By listing them directly, we preserve flexibility and avoid unnecessary taxes. Meanwhile, listing the trust as the beneficiary of their taxable investment account allows those assets to be distributed according to the estate plan and outside of the probate process. This kind of setup helps ensure the plan stays coordinated, efficient, and consistent with their goals. When you complete your estate plan, your attorney and financial planner should work together to update your account registrations and beneficiary designations. This step is often overlooked, but it's critical. Sometimes people spend thousands of dollars on a beautiful trust and estate plan, but never actually connect it to their accounts. The result? Their estate ends up in probate anyway. So before you make any updates, ask yourself and your attorney, do my current beneficiary designations still match my estate plan, and does my trust fit where it should? Your beneficiary designations are just as important as your will or trust. They determine how efficiently your money moves to the next generation and how much of it stays with your family instead of the IRS. If you found this information helpful, please give us a thumbs up and don't forget to subscribe for more financial insights. Thanks for watching, and we'll see you next time. Once again, I'm Mike Heatwole, founder and CEO of the Dala Group. If you are interested in seeing how we help our clients, visit us at www.thedalagroup.com. Give us a call or schedule a time to connect with one of our wealth advisors. We would love to hear from you.